Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, February 6, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is more liquidity coming from China, plus the soft landing versus no landing debate is back on in the U.S., and more hawkish Japanese wage data. So the nuance there is the Shanghai Composite rallied 3% as President Xi is said to be preparing more forceful measures to shore up the nation's equity market. Elsewhere, the January ISM Services PMI report supported the no landing scenario at the expense of the soft landing theme. Elsewhere, the 1Q24 Senior Loan Officer Survey from the Federal Reserve supported the elevated probability of a soft landing currently underpinning the current Goldilocks market regime. Lastly, Japan's December wage data were supportive of our call for the BOJ to further normalize policy in April. In terms of market implications, anything that Beijing does to rally Chinese equities for more than a couple of trading sessions will undoubtedly add to the positive global liquidity impulse our macro weather model has signaled since mid-November. The 2Q24 Senior Loan Officer Survey may dramatically inflate the probability of a no landing if next quarter's data reads as positive as Q1 report does. The specter of BOJ policy normalization amid a potentially rising probability of a no landing in the U.S. economy means investors may have already seen the year-to-date lows in global bond yields. Transitioning to my 42 macro dashboard. As always, we'll break down a question from one of our clients here in our community. We'll read the question here. It says, Darius, thank you for cutting through all the noise out there. You are most welcome, my friend. That is what we do here at 42 Macro, is translating noise into signal. There's a lot of noise out there if you spend any amount of time on Twitter or any amount of time listening to finance podcasts. But anyway, getting back to the question, I wondered if there's any value to breaking down the jobs data by sector, if available, like financial, tech, construction services, etc. If so, were any of these sectors rising and falling, and would these give a better indication of where we are in the business cycle and therefore position portfolios? Thanks in advance. So the question, the short answer to the question is there value to breaking down the jobs data by sector? The obvious answer is yes, particularly and specifically with respect to trying to glean insights for particular sectors. If you want to understand what's happening in what's likely to happen to home builder stocks or what's happening in the housing economy, obviously monitoring jobs in the construction sector are important in so much that if you're trying to get a sense of where margins are headed for some of these mega cap tech companies, monitoring employment trends in the tech sector can be helpful. But broadly speaking, if you're trying to figure out where you are in the business cycle, monitoring it on a sectoral basis is less relevant. What you want to monitor there is income growth. The amount of total income the labor market is generating vis-a-vis the total amount of people who are being employed, the total amount of sort of what they're making, on an hourly or weekly or monthly basis, and ultimately how much they're working from hours work perspective. So there's three metrics we use to track labor, income being generated from the labor market, particularly for private sector employees. That's our private sector labor income metric, which is the frequency adjusted productization of the private sector employment, private sector average hourly earnings, and private sector average weekly hours. We also track private sector or nominal employee compensation within the BEA PCE report at the end of the month. That's an important statistic as well, because that sort of kind of helps us it helps square the circle with respect to any discrepancies in private sector labor income. And then lastly, we get on a quarterly basis the private sector employment cost index from the BLS as well. That's the best and broadest measure of wages. Obviously, it's only quarterly, so we need to use monthly data to sort of supplement that inter-quarter and get ourselves put ourselves in a better position to spot critical inflections in the economy and ultimately the business cycle in real time. So just wrapping up, right now we have two of those three private sector income metrics are currently below trend or at or below trend. That's the private sector labor income that is below trend at 2.2% 3-month annualized, and the private sector, the nominal employee compensation is currently at trend at 4.4% 3-month annualized. The private sector employment cost index is at 3.5% 3-month annualized, which is slightly above the 2.4% trend rate. So perhaps we'll get there by the end of the Q1. The data will be reported in April, but obviously we have to see how the monthly data evolves throughout the quarter because we're starting to see some elements of sticky inflation in the wage statistics and in the price statistics, as evidenced by the ISM services PMI. So we'll wrap it up. Everyone can go review our lead off morning note today for more details on that and all the charts and all the analysis, and then ultimately what to actually do about this stuff, because we don't just opine on macro like most other investors. We help actually investors build, construct thoughtful portfolios, proper asset allocation and risk management associated with that. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, February 6th, 2024. Everyone have a wonderful day out there. Best of luck out there. Catch you back here tomorrow. Cheers.